What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Sorry for the late stream today. I am streaming on YouTube, Twitter, Rumble, and Telegram. My Telegram folks are holding it down there. If you guys want to join the community, check out t.me/Bitcoin and Markets. Kind of a hectic day today. But what I want to talk about today is yesterday I was listening to a Twitter Spaces. I believe it was a Swan Bitcoin space. And there was people on there that were talking about how the Fed prints money, and I mean, if it's gospel, it's unquestioned gospel, and you're a heretic if you say that QE is not money printing, that the Fed is not monetizing the debt. So what I did was one of my favorite kind of, I guess, living economists right now, Lacey Hunt. I went back and rewatched a bunch of his stuff, read a couple of his past newsletters from Hoisington Capital. And so I found a clip that is very relevant to this conversation. So we're going to watch that and comment on it. Should be a pretty quick stream here today. But before I get into that, let me share my screen. Where is it? Sorry, looking for my website. There it is. Geez, that took a long time. So this is bitcoinandmarkets.com. Check it out. That's where all my stuff comes out. Today I did release the second part of this demographic collapse series. I went through several case studies of, let's see, Hungary, Denmark, South Korea, Japan, and Israel, and commented on that. Looked at all of their different fertility-based subsidies that they have, their whole progression throughout the last, say, 40 years. And then in the next post, I'm going to hopefully, I keep extending these things out, but in the next post, I'm probably going to be writing about where this fertility problem is coming from and what are some possible solutions. Because, we're always told that we don't know how to stop this decline. And by the case studies that I present in this post, that is true. Nobody has been able to reverse the decline. And so, even Israel has just stopped the decline at 3. They have not gone below replacement and reversed back above replacement. No society in history has been able to come back from sub-replacement fertility. It has not happened. So anyway, that first goes out to my paid members on bitcoinandmarkets.com. So if you'd like to support me for $5 a month, get first access to blog posts like this. This will be made public here probably in the next week. But check out bitcoinandmarkets.com and sign up. All right, let's look at the price chart. We got some action going on here finally. So sitting at 26,600, breaking this kind of ugly descending trend line here. And we'll see if we can hold that. I have not been watching the price. This very low volatility time has finally gotten to me, guys. It has finally gotten to me that I only check the price like twice a day. And, usually I'm checking it every hour, and I'm on the charts looking at things for hours a day. But right now I'm only checking Bitcoin every once in a while. Let's take a look at the dollar because it has been recently rallying as well. Now back above 105. Let me go to the weekly. That'll be a little bit better chart here. And you can see, I mean, this is how many weeks? I think it's 9 weeks in a row. 1, 2, 3, 4, 5, 6, 7, 8, 9. This is the 9th green week in a row. That is a dollar wrecking ball. It's not going up as much as it did, say, in early 2022. But if this continues, it's going to spread a ton of pain. Let's check out the CNY. CNY on the week is down, so it looks like that pressure is being relieved a little bit, whatever they're doing over there. U.S. 10-year yield, 4.28%. might be breaking to new highs, but haven't seen much of that action recently. Oil, man, oh man, has oil had a big week here? Let me zoom into the daily. And breaking $90 today. That's a big move. There's lots of different things out there. People have talked about recently about Saudi Arabia talking up the market a little bit, and possibly MBS trying to sell in size at a higher spot on the chart. We will see what comes of that. There was a little back and forth between OPEC and the EIA in the US. I believe that's the Energy something administration. That's where I get all my oil charts from and stuff. The chief of the EIA came out and said, oh, we're going to have peak oil demand by 2030. And that's one thing I've been saying, that not forever ever peak oil demand, but we're going to have peak oil demand for a couple decades probably. And whether that's already in or that's coming in the next couple of years, that's possible as well. But the overall trend for oil demand is down. I mean, just tying it back into demographics. I mean, we're going to lose half the world's population in the next 100, 150 years. Oil demand is going to go down most likely. And so we are very close to peak oil demand. Now, the EIA chief didn't say because of demographics or because of recession. What did they say? Because clean energy, solar energy is so great, wind is so great. Of course, that's the idiotic reason. But I believe they're accidentally right, okay? There's a lot of cases of being accidentally right. But anyway, OPEC came back and slammed them. I mean, they had a really great response saying, you are insane to think that this is going to happen, that because you're going to cause a lot of lower investment into the energy industry, and you're just going to walk us down the road towards economic disaster if you keep preaching like this. So they had a big fire back and forth, and it was great. But anyway, oil price, yes, is over $90 per barrel right now. Okay, I'm going to jump over to this tab, and I'm going to share my screen on Telegram so you guys can get this as well. There we go. All right, you are seeing that. Hopefully the sound comes through okay. Remember, this is going back to the conversation of, does the Fed print money? It was a very simple question. Does the Fed print money? And I'll answer the simplistic side of this, because when you Google it, they give you not the answer that you want. The answer that comes up when you Google it is that no, they don't print physical currency even. They give an order to the Treasury, and then the Treasury is the one who prints the physical currency or mints the coins or whatever. So they don't even print the physical currency. Most people think that they print that. But they don't print money either, like digitally. Just because Ben Bernanke says that and Jerome Powell says that, they are trying to influence the narrative. They're trying to influence markets by what they say. So you can't necessarily trust what they say, right? Obviously, people know that. But people will believe them when they tell them that they print money. But okay, let's get into this, and I'll make sure to check the levels on the audio. And let me just make sure all of my systems are go on Restream on my streaming software. Okay. Let's press play and get into it.
But there was an interesting story I'll tell you. There was the chairman of the Housing Committee.
Okay.
In the 60s.
Oh,
was a congressman from East Texas by the name of Wright Patman. And Wright Patman was a very serious critic of the Federal Reserve, and someone convinced him that the Federal Reserve, in fact, had the ability to print money. And so Wright Patman, to his credit, found the two leading monetary theorists of the time, except, or two of the three, Carl Brunner and Alan Meltzer. And he funded a lengthy study which he published to address the issue of whether under the Federal Reserve Acts the Fed could print money.
I went back and looked for this and actually found it. It is very convoluted and long. It comes like in 4 different parts, so it's hard to follow exactly like when this was written and what they're talking about necessarily, because they wrote it for a subcommittee in Congress where this Patman guy was the chairman of. It wasn't the banking committee or the, whatever it is today. It was I think it was like banking and currency or something, but that's what it's from. It's from the records of this subcommittee, and it says exactly what he's saying here. So let's listen to what Lacey Hunt says. Does the Fed print money?
And the publication is very valid. Carl was a mentor of mine, really brilliant fellow, and
I think Lacey Hunt's like 91.
I knew that well. Anyway, they concluded the Fed money, that they could increase liabilities to whatever extent needed, but that the money supply was, in the final analysis, determined by not only the Fed's balance sheet, the monetary base, but the money multiplier, and that the money multiplier is an endogenous variable. Endogenous means it's not controlled by the policymakers. And so the Fed can inject the reserves, but to utilize the reserves, the banks and their customers must be able to profitably employ the reserves. And what we're now learning,
and that's what I've been saying a lot, is QE is an asset swap. They swap for liabilities, one asset for the other. And the hope is that it will sterilize the reserves of the banks. And then the banks, with the money multiplier, will go out there and lend money into the economy. So he's saying it in very technical terms here, but it's all around the level of reserves and the money multiplier. If you increase the level of reserves, which are not money, okay, they are not fungible dollars. I can't take reserves to the grocery store and buy a Snickers bar with them. I can't even buy, well, let's listen to Lacey Hunt because he has a few examples as well.
Because when economies are more and more indebted, the risk premium rises, the risk of default rises. And so it's more and more difficult for the banks to pass through all of their costs to their customers.
Right.
And so if you look at the economic textbooks, they will tell you the money multiplier should have been 10 because the reserve requirement was 10. And so they apply the binomial theorem, voila, a $1 increase in reserves leads to a $10 increase in money. Now
that's the fractional banking thing. If you have a if you have a 10% requirement for reserves to back your loans, then you can plus up the amount of money in the system by 10, right? So that's just a fractional reserve banking, exactly what he said. However, the money multiplier doesn't work like that because it continually goes down when there is economic contagion. As you're getting over indebted, there's the risk of default goes up. And so the money multiplier effect will continue to drop. It doesn't matter how many reserves you stuff into the banks. QE doesn't matter. QE is not money printing. They're trying to stuff the reserves into these banks to boost the money multiplier effect, but it's not working because it's, first off, if you have to do QE, that the signal is something's wrong with the economy. Plus, we're over indebted, right? So 2 things right there are crash bank lending, no matter what you do, because printing reserves is not printing money. But let's see what else he says.
Now they have eliminated the reserve requirements. That was one of the steps that they took. And in spite of that fact, the money multiplier is down to 3, and it's moving lower. And in my opinion, it's going to continue to move lower because the Federal Reserve does not control little m. However, you circumvent the Bruner-Meltzer equation when you give the Federal Reserve when you make the Federal Reserve's liabilities legal tender. Because at that point in time, you meet money, and you can go to any major textbook you want, and all the minor ones too. Money has to have 3 criteria. It must be a medium of exchange. The Fed's liabilities are not medium of exchange. They sit on the Federal Reserve's balance sheet. They cannot be used to buy a football stadium or to pay salaries. It also must be a store of value. It's not a store of value. And it must be a unit of account. To be a unit of account, it must circulate freely. So Fed's liabilities are not money. They can have an impact for a limited.
Jeff Schneider says that they are statutorily money. In the law for, gap accounting, or, the accounting rules, that you can count these reserves on your balance sheet as cash or as money. But that's only, that's not real. That's just based on an accounting fiction. What did he say here? Legal tender. So he said, once you make the reserves legal, the liabilities of the Fed legal tender, a medium of exchange, which they are not. They are not fungible with dollars, remember. They are reserves. But once you make them legal tender, that's when the hyperinflation really comes. In other interviews, what he has said is that they specifically set it up so that the Fed could not print money, they could only print liabilities. And once you let the central bank be able to print money, that's when you get the hyperinflations. So if you think of like Argentina or something, the central bank must be able to print actual money, not just liabilities. Each central bank is going to be slightly different. It's going to be set up slightly differently. But okay, let's finish out this video.
Period of time, but ultimately it depends upon the interaction of the money multiplier and the Fed's balance sheet. But the analysis doesn't stop there, because the money supply is not directly linked to GDP, because there's also another intervening endogenous variable called the velocity of money.
Right.
And the velocity of money is outside the Fed's control. And what we're learning is that when Fisher in 1933 wrote that in highly indebted economies, the velocity of money falls. So what has been happening in the United States, Europe, Japan, China, as we become increasingly more indebted, the velocity of money is falling. And it's falling in line with the marginal revenue product of debt, which means the amount of GDP created per dollar of debt. And in other words, when the product of debt declines, it's confirmation that diminishing returns is at work.
Right.
All right. So that is that. What I want to say about velocity of money is I'm one in the camp where I don't believe that velocity of money is all that important, especially at this time. Like he said, that even the main economists of the past that thought velocity was very important, when you get highly indebted, when you get to the end of this credit cycle, velocity of money is just going to be the inversion of the M2. So like M2 supply, if you just take a mirror image of that, that's what velocity is. Because we have gotten to the point where the money multiplier and all this stuff, they're so low that they are indirectly perfectly correlated, velocity and supply. So anyways, that's where I'm going to leave it here today, guys. Check out bitcoinandmarkets.com. New post dropped about the demographic collapse, and that's available for paid members at this time, but I'll put that public here in a few days. And that's going to do it. Thanks for joining me. Have a good rest of your day, and I'll see you on the next one. Bye.